Thanks for tuning in for another one of our educational videos. David, Kevin, and myself today are going to talk about bonds. Bonds play an extremely important role in our markets. Most people don't realize the bond market's actually almost twice the size of the stock market. Again, a lot of people don't realize how important they are, so I'm going to enjoy listening to David and Kevin educating us on that. What are bonds, how bonds work, and the outlook for the bond market over the next 12 to 24 months. So Kevin, why don't you start off and tell us, so what is a bond?
A bond is a debt instrument. A bond is money that you lend a company or a government in exchange for a set interest rate for a period of time. When companies or governments want to raise money to help finance their operations, they can issue bonds to do that. As an example, if a company wants to raise $100 million to build a factory, they can ask lenders to loan them money in exchange for receiving an interest rate over a period of time. So if a company says they will give you a 6% interest rate for a 5-year period, that 6% interest rate is the coupon rate of the bond, and the 5-year period is the term to maturity. If investors feel like the corporation or government that's issuing the bonds is in a good financial position to make good on the obligation to make the interest payments, then you can choose to invest in that bond. However, if you don't feel that they're in a good financial position, then you can choose not to invest in that bond. Bonds issued by corporations are viewed as higher risk than bonds issued by governments from developed countries like Canada and the US. Because they are viewed as higher risk, they usually offer higher interest rates. However, they also have a higher risk of default. And by default, we mean that they could run into issues where they can't make payments, the interest payments on your bond.
David, how do bonds work?
Well, if you invest in a bond, you're basically guaranteed to receive a certain set of interest payments over a set period of time. And then eventually at the end of that time frame, the maturity date, you get all of your principal paid back, at least in theory. So they're pretty simple when everything goes right, but they can get complicated pretty quickly. So bonds are also impacted by interest rate fluctuations. And as we all know, living through 2022, interest rates can change. So in Canada, the Bank of Canada is responsible for setting interest rates. And as we all know, when the pandemic first occurred in 2020, the Bank of Canada, because of everything that was happening in the world, the fact that the government was making us all stay home, the economy basically ground to a halt overnight. So to make sure that the economy could make it through that period, the Bank of Canada lowered interest rates to close to 0% to make it easier for people to make their payments and kind of get through. Once everyone eventually got back to work in late 2021, we started to see signs that inflation was going up. And obviously, we know in 2022, inflation peaked at close to 9% in the summer. In response to inflation going up, the Bank of Canada raised interest rates to close to 4% over the course of 2022. As that interest rate goes up, that impacts the bond market tremendously. So let's say I bought a bond issued by Microsoft in January of 2021, and it's a 5-year bond paying me 2% per year, and I put $100,000 into it. And then we fast forward to January of 2023. Interest rates have gone up, and Microsoft is now issuing new 5-year bonds today at paying 6% per year. So if I need that $100,000 back and I want to do something else with it, let's say I want to buy a new home or reinvest in my own business, I can sell that bond on the secondary over-the-counter market to another investor. So let's say I want to try and sell the bond to Harry.
Me? Why would I want to buy your bond at 2% when I can get 6% now, David?
Well, you would have to negotiate with me. You might say, hey, David, I'm only willing to give you $92,000 on that bond because I can buy a new bond at the prevailing interest rate of 6%. And I would kind of have to eat crow there and say, okay, well, you're right. You know, I do have to give you a discount, and we might settle on a price of, say, $92,000 for that bond.
So how the bond works is that you have to give up a little bit of your capital to make up for the interest rate differential.
That's correct.
Okay.
Yeah, that's correct.
If you own an individual bond, then you don't need to worry about how the prices are fluctuating in the bond market. You just hang on to your bond, you clip your coupon until it matures. However, if, like their scenario, you need to get out of your bond early and sell it to gain liquidity, then the prices of bonds matters. It also matters if you hold a bond fund or a bond ETF, as many investors do, as these offer daily liquidity. So they are repriced on a daily basis as interest rates fluctuate in the market.
So in other words, because they're priced in daily, that's why you see the fluctuation in the bonds, where if you hold on to the bonds till maturity, you actually get the underlying interest rate. Okay,
Exactly.
that makes sense to me. David, what's the short-term outlook for the bond market?
Well, the short-term outlook is quite a bit more upbeat than it has been for quite some time over the next 12 to 24 months, let's say, for the bond market. Obviously, in 2022, bonds had a very challenging year. In fact, it was the worst year for bond performance since 1994. And the reason being is that interest rates went from less than 1% in Canada at the beginning of 2022 and the tail end of 2021 to nearly 4% by the end of the year. So that might not sound like a lot, 1% to 4%, but it's an absolutely massive move in interest rates over the course of, really, it happened in less than a year. So that had a massive impact on the prices of bonds in 2022. As we've just explained, the prices of bonds were marked down in 2022 because all the bonds that were paying a lower interest rate, people can now buy new bonds at the higher prevailing interest rate. So now going forward, that should help the outlook for bonds because we're sitting at a much higher interest rate level today than we were a year ago.
On your screen now, you will see a helpful chart which shows the performance differential going back to 1986 between the FTSE Canadian Bond Universe Index and the average one-year GIC rate in Canada. You should notice two things. The first is that the average one-year return for the Canadian Bond Universe is substantially higher than the average return of a one-year GIC. So over time, investing in bonds has yielded Canadians more wealth accumulation than one-year GICs have. The second thing to take note is that virtually every time the one-year GIC return beat the bond index return, the year following saw the bond index outperform the one-year GIC, sometimes by a considerable margin. The last 2 years have been an exception, where the bond index lagged one-year GICs in 2021 and lagged again by a much wider margin in 2022. No one can say for certain what 2023 and 24 return differentials will be, but based on the fact that inflation is beginning to cool and what history has shown, we expect bond returns to outperform GIC returns over the next couple of years.
Thanks, David and Kevin. Those are all excellent points. We know bonds can get very complicated, so that's what we're here for. If you have any questions with anything, please don't hesitate to give David, Kevin, or myself a call. And as always, we hope you and your family are doing great. Take care.